Welcome back, everyone, to Profluence Sports. Got my man John here today from Relay Ventures. So, John, appreciate you hopping on.
My pleasure. Nice to talk to you and all your listeners and
I
all the
know,
other.
it's great. It's great. The problem is we cut off probably 10 minutes of great conversation before, but it's all right. We'll rehash some of it, and some of it we won't. But nonetheless, I guess just give us the quick 1 minute spiel of who you are, what's Relay Ventures, and what you guys are doing in sports, and then we'll start to dissect it a little bit more and give the people what they want.
Okay. Relay Ventures is a Toronto-based venture capital firm that invests all over the world, but primarily North America and primarily the United States and Canada specifically. We have three focuses. One is property tech, the other one is fintech, and the last one is sports tech and media. And I spend all my time on sport techs and media. Probably the last 20 years or 20 to 25 years we've been investing in this space. Includes gaming, includes gambling, includes infrastructure, software, teams and leagues. Currently the investment team that focuses on sports is very focused on the emerging and niche sector of sports.
Super cool. And from going back, like when did you start to have an interest in sports? When did you see this as an investable industry? And then again, mainly, obviously you said teams and leagues, but you're also at the earlier stage side for clarity for a lot of people as well.
Yeah, that's a very good point that I didn't mention. Yeah, we like to start at the seed stage, even on the angel stage or pre-seed, very focused on this space and only this space. And what we're trying to do is invest in companies that are either pre-product, pre-revenue, or just post, have two beta customers or two pilots, maybe 50,000 in revenue or a couple 100,000, and they need capital to expand, hire appropriate employees, and build out their infrastructure. And, so we like to start with a check that's somewhere between 250,000 and $1 million. We partner on every deal we do. We don't do anything solo. So we like to bring other professional investors in sports that have a different network, better value than we have, or additional value to what we have, and surround the entrepreneurs or their founders with experience and knowledge from prior investments.
And at the early stage, how do you evaluate? Obviously, like you said, the revenue, the traction is obviously usually very minimal. Are you a people evaluator? Are you a market evaluator? Both? Like what sort of goes into what Relay evaluates from a high level?
Okay, well, people/founders is number one. Number two would be the addressable market, and not like, we don't look at sports and say, okay, it's a, $500 billion industry or whatever that large number is.
So when you see a 500 billion in slides, you're like, these people have, it's just too broad. Like I see that all the time. It's like, what are you doing here? Like we all know it's a huge industry.
Yeah, so we're not asking about the market. We're asking about the addressable market, right?
Yeah.
Like how many teams or leagues or fans or venues or whatever it is are using the product, and what would they pay for it? And can we see a path to $100 million in revenue in 5 or 6 years? And can we see a path that leads to profitability? And typically, we know the founders, but we don't know them well. So that's why we like to start with a small check. And that's why we like to start at pre-seed or seed. And then over the next 12 to 18 months, the founders will prove to us that they're strong operators. They work very hard. They're passionate about what they do. And we'll have some operating metrics that we both agree to, founders and whoever the VCs are, specifically Relay in my case. And if they hit them, then we're there for the next check, and we want to lead the next round, and we want to write if the next round is a $10 million round, we want to write a check for not less than 3 and probably 5, and sort of step up our ownership, and not so much the ownership, but the amount of capital, right? So our goal is if we can get $10 million of capital and we're right, and we make 10x our investment, then we make $100 million, and 1 or 2 of those make a fund, and everybody's happy.
Yeah, and how do you, so from an allocation, like if you look more internal, you're very much a big reserves, for the follow-on rounds, you guys keep a ton in the backlogs there, and then you're really, baseline evaluation, but your real evaluation is actually in the first year or 2 years. And then, do you, if some aren't going, like, do you sort of, even though you have $1 million or say in it, like, do you just kind of write it off and then you start to double down both in capital, attention, time with the ones that win? I'm always curious, like, from the internal, how you guys view that.
That's pretty close to what we do. Yeah, the ones that don't have traction for whatever reason, we'll spend less time and effort on, and we won't lead their A, and they can still pivot and move around and maybe prove themselves. Like, we don't walk from them, but we don't lean in hard. And the ones that prove out the, goals and operating metrics in the first 12 to 18 months, we lean in very hard. And with our money and our effort and our work, like, our time's worth more than our money to us. To the founders, I'm not sure that's the case. They value our input and influence in it, but everything's still their decision. We never tell any founder what to do. They know more about their business than we do. We just try and, challenge them where appropriate and add value where appropriate, right? And where they don't need value added, we're happy to step back and say, wow, you guys are amazing. We don't have to do anything. Like, that's God's gift, right? But at the beginning, there's typically 2 founders, sometimes 3, and they got to build a team, and we end up acting as a executive search firm also, right? Pulling on, 2 ICs or 3 ICs in prior startups that have been sold to, other media companies or sports companies or, betting companies or gaming companies. And then those people want to start again. They don't want to work in big enterprise. They stay there for a couple of years as they have to for transition, but then they're ready to go again. And even if they made a huge amount of money, they can't stand not playing.
Yeah, no, and I feel like Nick Salsky Curling Group fits that. I don't know if that was all you guys behind the scenes, because I know he's part of the gaming deal. I don't know if you're investors in that, but I just was talking to Nick, so I was like, now it's starting to make sense as you say that, and I see what's going on. But
yeah,
super cool.
Nick comes from the gaming world,
Yeah,
and the gambling world. The words sort of travel together. But Nick is like a crazy great founder. He's exactly what we love. Like, he's right out there. He's, sort of consumed by the sport, didn't come from the sport. When you meet him, you think he knows more about the sport than anyone you know. And he's all over it. Like, he works, 7 days a week, 24 hours a day. And he's making like a life bet on this, right?
yeah.
He's doing an amazing job. We love him. That's really unusual for us, that kind of transaction, because what we're trying to do is make investments in solutions that create revenue and support all the emerging sports leagues and the niche sports leagues that on a global basis, they're not niche, but on a domestic or national basis, they are. Like, if the Shaun White is an exception and F1's an exception, but because, I know those people and I'm not like a fan of either sport. But if a curler walks in the room that's a 3-time gold medalist and world champion, most people in the room aren't going to know who the person is. That's true in paddleball and pickleball and, darts and TGL. There's like so many of these sports that tech and legalized gambling have made, an emerging sport that has the capability of being what the NFL was 20 years ago. Like, streaming tech is so important. So they can produce and distribute content at 20% of the cost of the existing production companies, right? And then you have betting. So if you can get the data and produce odds, which is another one of our companies that you've spoken to, Alt Sports can do, then you have another stream of revenue. And in the past, it was only media and sponsorship. And if you weren't a national content provider, like if you didn't have enough fans in the country that you're sort of domiciled in, you couldn't get off the ground, right? In the United States, 350 million or whatever it is population. For NFL and baseball and NHL and everything like that, that's great. Or FIFA in Europe, it's great. And all these different leagues that had domestic large audiences, you didn't need tech to create revenue. But today, if I take curling as an example, 250 million fans around the world that are passionate about the sport because of technology and the cost of distributing that content. And then the fact that you can like engage them and allow them to bet in-game, pre-game, post-game, like all that stuff. All of a sudden you have a sport with 3 or 4 legs on the stool generating revenue, and you can get it off the ground. And it's not, you have an investment at the beginning, $0 to $25 million to get it off the ground, and then it can carry itself from there on a profitable basis. And then you have all the tech for in venue, right? Ticketing, merchandise, like all that stuff that you can produce digitally now, as opposed to having someone in the office outsourcing production to a t-shirt company and stuff going back and forth and shipping it everywhere from the wrong place. It was horrible. And now you have tech that allows you to light up a venue that has 3,000 fans, not 20,000 fans. So in the past, that wasn't economic. You couldn't light up a venue with 3,000 people in it. It was just, you'd lose money on it every time. Today, you can do that at a fraction of the cost, right? And you don't have 15 people working in the venue to do it for yourself. So it's amazing what you can do with, fandom and engagement that way. And what, if you can get the content to them, and then they'll watch the content, stay engaged for a long period of time, and bet or buy merchandise while they're watching, right? And so it's all about getting into the fans' wallet.
Yeah, and it's sort of, I think you've talked about this to me before, but you call it like the donut of sports or something like that, where it's like you have the teams and the leagues and the tech and the gaming and all the stuff around it. Is that a large part of your thesis? Because if you look at your portfolio, like you said, you have some properties or leagues or teams, and then, or I don't think you have teams, but you have the league side, and then you have obviously the tech. Like, how do you sort of, number one, view it and then mesh it together, number two?
So your description is accurate. So we believe that the new emerging teams and leagues, including female sports, are in the middle of the donut, right? So we put teams and leagues in there. And then they need about 10 solutions, 8 to 10 solutions around all these teams and leagues to generate revenue, right? So they can't, because you can't just feed it with hundreds of millions of dollars to pay the athletes and pay the leagues and pay the production without generating revenue. So what's happening is all these leagues and teams that are niche and small need to evaluate, who do we use for tickets? Who do we use for merchandise? Who do we use for hospitality? How do we move people around at the stadium? How do they check in? How do they not? The betting in venue and out of venue, the content streaming, they need all these things. And so today, what happens is that these teams and leagues, and even the venues separately, some of the venues are owned separately. It's not like, where the world and the NFL has gone, we own the team, we own the venue, and we own the land that it's sitting on, right? And they're developing homes around it and building retail, and
nuts.
It's crazy, but it's crazy great.
Yeah. I mean, there's groups just doing the real estate side now.
Yeah.
It's pretty wild, but go ahead.
I agree. So
yeah.
If you're going to own a team, you're going to locate it somewhere, and you can own the land before someone tells the world they're going to put a team there. Imagine the increase in value, right? So it's amazing. So I think, but anyhow, what I'm getting at for us is those teams and leagues today evaluate best of breed solutions for all the things that we talked about, in venue, out of venue, digital and offline. And it's very difficult. So then you need someone in procurement for all these teams and leagues and venues. They need it too. And so who's going to do that for them? And when they find someone to do it, that one person might know about one or two of the solutions that they need. They might understand ticketing, and if there's only 3,000 people in the venue, Ticketmaster's too expensive. Who are the mid-market or small providers of ticket solutions? And then they got to do it in merchandise, and then they got to do it in venue engagement, then they got to do it betting. So what Relay's decided to do, as a result of our participation in 3 of those solutions already, is said, we're going to create an affiliate platform owned by Relay, where we put what we call the donut, which is those solutions around the teams, and try and connect all those separate solutions. So in our case, we eventually want to connect all sports data with home team networks, with Pressbox, and with other ticket providers and everything like that, so that we can go to a team or a league or a venue and say, here, we've already evaluated, and we have the best of breed companies that are either brand new startups, because this is sort of a new world, or they're like small businesses that did exist for like 2 venues in 2 small towns, where it was an entrepreneur who wasn't thinking global because the tech wasn't available. So we want to procure those. We want to invest in those. We want to connect them so that when one of them sells to a team or league or venue, it can drag along the other, 5 to 8 of them, right? And we can say to them, like, instead of you spending 3 years probably evaluating it and slowly installing it, we can come like with the whole solution. So that donut, and we can go to the team and surround them and say, hey, this is what it costs. This is, your revenue. This is our revenue. This is how we'll share it. And we both win, and you can deal with one provider. So that's what we're trying to do it. We're calling it Player 12. Player 12 is like going to launch in the next 90 days. And we want to continue to do what Relay's doing, but we want all the sports stuff to sit in a separate entity so that we can build like like we talked about it, that's connected, as opposed to, having all sports data all by itself and having Pressbox all by itself, because Pressbox can do all the content with their AI agent for all the teams, for all the sports, and even, Alt Sports could be a customer of that, because Alt Sports needs content and media to generate revenue for the sports books and the leagues and teams. And same with curling. Curling needs it too. So our investment in the curling league was very opportunistic because it came out of Canada, because we bought the Grand Slam of curling. Even though it's a global sport, it happened to be owned in Canada for historic reasons that don't make a lot of sense, to be honest. But that's the case. And we sort of use Nick and his team of Mike, and many more to evaluate all these best of breeds for ourselves. We sort of say, like, okay, if, the curling group wants to use it for betting, or they want to use it for venue management, or they want to use it for merchandise, why wouldn't the other leagues and teams want to do the same? So why don't we install it, see if it works, put capital in that company, and try and connect all the different founders with AP, like on a technology basis and on a personal level.
Yep.
And get them to work together. So we're quite excited about it.
Yep, and I think it's just a good call out too for founders listening, is if you hear sort of, behind your words, a lot of what you're saying is it's about creating this synergistic portfolio of things that go together. And so like as a founder, you should look at what other firms are investing in and see like, you can probably tailor your pitch or how you're building or whatever toward it. So anyway, I just wanted to call that out. But I'm curious, John, you've been in sports now for a bit. Anything that worries you about the space? Like most of my conversations, everything I always talk about, it's all great, good. But you've been in it just longer for most people. So I'm curious seeing the evolution, like anything that worries you a little bit about just where it is, where it could be heading?
Well, it's kind of interesting. So, as sports has, really in the last 12 months become an asset class all by itself. And we're seeing private equity shops and family offices, which are the families that owned all the professional sports leagues, starting their own private equity shop, or separate families deciding, I want to own an NBA team, and it's generational wealth. Like they're not buying it to sell it in 5 years. They're buying it for 50 years for their grandchildren to lock up money, the same way a lot of families buy real estate and just hold it because it's a good hedge against everything. It's sort of like they're wealthy enough that they're trying to preserve and protect their capital. They're not so interested in making $1 billion on $1 billion. They don't want the $1 billion to become worth $500 million. So that at the top of the food chain, which is private equity, family offices that are buying teams for multi-billions right now, are making a bet that I believe in. And the question is, like, is the value at a peak? Is it going to come off and then go back up again? And can they survive the sort of depreciation of the value for a period of time before it comes back, right? So, the question is, are they overpaying or are they not overpaying? I don't know the answer to that. In the long term, I believe they're not. So you got to be able to carry yourself. On the startup side and what's going on in emerging sports, it's not highly populated. Like we partner with other VCs in this space, and there's like 8 to 10 of them that do it, and everybody's sort of writing the same size check to start. Like everyone wants to write a check from 500,000 to a couple million to test the business thesis and then lean in if it works out. So, and some of them can't lean in. Some of them are like doing it once and then letting others pick it up. But we believe we're a little bit ahead of the curve, but there's more money coming into our sector. But because of the capital markets today and how sort of tight capital is, venture is an asset class that institutions are not interested in today. And that comes and goes. right? Like every 3 to 5 years, there's an influx of innovation and building startups. And then there's a collapse of the economy like there is now. And investing in a company that's going to lose money for the first 3 years is not something that anybody likes. So, so today, from an investment perspective in this space, it's an amazing opportunity. As long as you're a buyer or an investor, it's great. But the only thing that would worry me is at the high end, which we're not participating in. So if I were to start a private equity shop to buy, the New England Patriots, which wouldn't happen, but or Milwaukee Bucks or like on any of these teams, and I'm not saying would sell anyway, the ticket price, like the entry price is massive, and it's a business, I guess, that I haven't done and I don't understand properly. But my only fear is that the values are hyper inflated. And so when we build Player 12 or Alt Sports or Pressbox or Home Team Networks gets to 100 million in revenue and you want one of those guys to buy you, or you want a media company or Disney or ESPN, whoever it is, or Microsoft or Liberty to buy the team or league or the infrastructure around it, which is what we're interested in, that infrastructure. What are they going to pay for it? And if their value went from 5 billion to 2.5 billion 3 years from now before it comes back over 5 billion, then, our returns will be adjusted that way. So it's really, the fear would be that the values come down at the top of the food chain, and that results, instead of us selling a company for 1 to 2 billion, that we're selling it for 500 to 1 billion. And we'll still make money, but it won't be, we won't be doing cartwheels.
Yeah, won't be as juicy. So and I'm blanking on the name right now, but I know you guys did a massive, like one of your biggest wins was a sports one, the Score, right?
Yeah.
Or tell us just a little bit about that. I know we only got a few minutes left from both our sides.
It's an incredible company with incredible founders that were always focused on betting, but had a very strong media company with individuals, consumers, mainly in the United States, that, logged onto their app every day. They were way ahead of the curve in terms of digital and mobile, like the first sports apps on iPhones and Blackberries at the time, and had a great audience that was very engaged and didn't leave them. They were always focused on betting. And when betting became legal, they jumped in. And in a market that, sort of ended at the end of 21, their market timing was great. They sold the company to Penn for $2 billion. If they were to sell that same company today in the current environment, it would go for 25% of that. So that's sort of the fear that I'm talking about.
Yeah. Timing is a big piece, and based on fund cycles or just internal cycles, it doesn't always align.
Yeah. So today we're getting in at a price because the market's depressed, where even if the hype cycle came down at the top of the food chain, we're still going to make money because we're investing at, ground zero values, right? 2 years from now, I don't expect it'll be the same. My marketplace that Relay and Player 12 are focused on will be heated 2 years from now. And instead of being 10 players in North America, there'll be 100. Right. And prices will get bid up, which is great for founders, but not so great for the investors. And then timing becomes really important. Right. So right now is just an amazing time to invest in these companies because everybody's talking emerging sports, but the startup size, like people are like scared to write a check because venture is not a game for the tourist,
I agree. Where can people participate? Meaning learn more about Relay, website, or any closing final thoughts from your side as well?
Yeah, well, Relay has a website, obviously, like relayventures.com or relay.vc.
Yeah.
And it lists all our portfolios and the participants. And if someone's interested in raising money in a solution that addresses the needs of the new and emerging sports, we'd be very interested in meeting them. You've been nice enough to send some of those companies to us already. And I think like out of the 6 that you sent us, we've done one. Yep. That's a high percentage rate for looking at deals and doing them.
Yeah.
So your distribution channel of content is amazing for us. And we appreciate it. And I'm sure the founders do too. And if they approach us, they'll hear more about that. And then they'll hear probably in 3 months the launching of Player 12. which is solely dedicated to it. So there's no there's no distraction by the other things that we do. It's the same team that works on sports at Relay, but they become 100% focused on only sports solution and infrastructures for there's new teams and leagues and owners and venues.
I love it. Well, good stuff, John. I appreciate you coming on, and we'll post all the links and everything. And yeah, excited to see the Player 12 announcement.
Yeah, thank you.
Very good.